As of October 8, 2025 at 12:20 p.m. Eastern Time, Tilray Brands, Inc., trading under the ticker symbol TLRY on the Nasdaq, is priced at $1.7277, reflecting an intraday gain of approximately 1.04%. This slight uptick is part of a much larger, more volatile picture that has defined Tilray's recent market performance. Many investors see this stock as a straightforward bet on the future of cannabis legalization in the United States, a narrative that has fueled incredible surges on whispers of regulatory reform. The expectation is that as laws change, Tilray, with its established international presence, will flood the market and become a dominant force. However, the reality is far more complex and hinges less on the headline-grabbing news of potential rescheduling and more on the company's gritty, day-to-day operational execution in brutally competitive markets. The real story isn't just about future hope, it's about present-day survival and strategic diversification that often gets lost in the speculative frenzy. While the market is pricing in a binary outcome based on U.S. federal action, the company is quietly building a beverage and wellness empire that could ultimately define its long-term success regardless of what happens in Washington, D.C. The common belief surrounding Tilray stock is that it's a high-beta proxy for the entire cannabis sector. Positive news about legalization sends it soaring, while delays or setbacks cause it to plummet. This view isn't entirely wrong, but it's dangerously simplistic. It encourages a trading mentality rather than an investment thesis, leading many to overlook the fundamental strengths and weaknesses of the business itself. The contrarian take is that Tilray's future isn't solely dependent on the U.S. cannabis market. The company has methodically been acquiring craft beer and spirits brands, such as Sweetwater Brewing Company and Montauk Brewing Company, effectively creating a parallel business that generates consistent revenue and provides a crucial distribution network that can be leveraged if and when cannabis-infused beverages become federally permissible. This strategy is a hedge against the notoriously slow pace of legislative change, a reality that has burned many cannabis investors. While everyone is watching the political headlines, the smarter approach is to analyze the performance of these beverage assets and Tilray's growing footprint in the European medical cannabis market, particularly in Germany. These are the tangible, revenue-generating parts of the business that are often overshadowed by speculative excitement. Many investors using platforms like the Robinhood app or SoFi Invest are drawn to the low share price and high volatility, seeing an opportunity for quick gains, but a deeper look through a lens provided by more sophisticated platforms like Interactive Brokers reveals a company in the midst of a complex transformation, not just a waiting game. Recent stock movement has been a testament to this volatility. Over the past few months, Tilray has seen its share price more than double, driven almost entirely by renewed optimism for cannabis reform in the U.S. Trading volumes have been immense, often exceeding 100 million shares in a single day, indicating significant interest from retail traders and day traders. However, this surge has also attracted short sellers, creating a constant tug-of-war. The stock has recently hit a 52-week high of $1.88, a significant milestone for a stock that was trading at a fraction of that price earlier in the year. Yet it has also experienced sharp pullbacks, often on no specific news, highlighting the fragile nature of sentiment-driven rallies. Institutional activity provides a more sober perspective. While some large institutions hold positions, many are likely doing so through ETFs like the Amplify Alternative Harvest ETF, rather than making direct, high-conviction bets on the company itself. Filings show a mix of buying and selling, with no clear consensus among larger players. This suggests that while institutions are not completely ignoring the sector, they are approaching it with caution, likely waiting for more concrete signs of profitability and a clearer regulatory path. An investor considering an allocation through Fidelity Wealth Management or a self-investing approach would need to weigh this institutional hesitancy against the undeniable retail enthusiasm. Tilray Brands is a global cannabis and consumer packaged goods company. Its business is divided into several key segments: cannabis, which includes medical and adult use products, distribution, primarily in Europe through its subsidiary CC Pharma, and a beverage alcohol segment that has been a major focus of its recent expansion. The company's cannabis operations are extensive, with cultivation and production facilities in Canada and Portugal. In Canada, it's a market leader, but the landscape is intensely competitive, with oversupply issues and pricing pressures constantly eroding margins. The European medical cannabis market offers a more stable, albeit slower-growing opportunity. The acquisition of Afria in 2021 was a significant move, creating one of the largest cannabis companies in the world by revenue. However, integrating two large companies has been a complex and costly process. Past performance has been a story of promise and disappointment. The company has consistently struggled to achieve sustainable profitability, with operating losses being a regular feature of its financial reports. While revenue has grown, much of that has been driven by acquisitions rather than organic growth in its core cannabis business. This has led to shareholder dilution, as the company has issued new shares to fund these purchases. Looking ahead, the future of Tilray stock presents a fascinating dichotomy of immense opportunity and significant risk. The most obvious catalyst is the potential rescheduling of cannabis from Schedule 1 to Schedule 3 in the United States. This would not itself legalize adult-use cannabis, but it would have a profound impact on the industry. It would ease banking restrictions, allow for more research, and, crucially, allow cannabis companies to deduct ordinary business expenses from their federal taxes, a change that could dramatically improve their profitability overnight. Tilray is well positioned to capitalize on this, with its existing U.S. infrastructure in the form of its beverage and wellness brands. However, the risk lies in the timeline. The process of rescheduling is a bureaucratic one, and there is no guarantee of when or even if it will happen. Any delays could see the current optimism evaporate, sending the stock tumbling. Do you think the U.S. government will reschedule cannabis before the next presidential election? Comment below with your thoughts. Another major opportunity lies in the international markets, particularly Europe. Germany's recent move to legalize cannabis for personal use, albeit in a limited fashion, is a sign of the changing attitudes on the continent. Tilray, with its EU GMP-certified production facility in Germany, is perfectly placed to benefit from any further liberalization of the European market. The risk here is the patchwork of regulations across different countries, which makes scaling operations a complex logistical challenge. The company's beverage alcohol business also presents both an opportunity and a risk. The opportunity is that it provides a stable and growing revenue stream that is not subject to the volatility of the cannabis market. The risk is that it could be seen as a distraction from the core business, and if the cannabis market does open up in the U.S., the company may find itself spread too thin. A diversified investor might see this as a positive, perhaps managing their risk through something like Schwab Intelligent Portfolios, but a cannabis purist might view it as a lack of focus. In summary, the story of Tilray Brands is a classic case of expectation versus reality. The market's expectation is that of a company on the cusp of explosive growth, driven by the inevitable tide of cannabis legalization. The reality is that of a company navigating a complex and challenging landscape, with a business model that is as much about craft beer as it is about cannabis. The recent surge in the stock price is a reflection of the market's optimism, but the underlying fundamentals of the business have not changed overnight. The company still faces significant hurdles to profitability, and the regulatory environment remains uncertain. The real test for Tilray will not be whether it can ride the next wave of cannabis legalization hype, but whether it can execute on its diversification strategy, control costs, and build a sustainable, profitable business in the markets where it currently operates. The ultimate success of an investment in Tilray will depend on whether the reality of its business can eventually live up to the market's lofty expectations. For now, it remains a high-risk, high-reward proposition, a stock that demands a deep understanding of the nuances of both the cannabis and consumer packaged goods industries.